Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back. In part 2 of this video, we'll go deeper into how to spot risky crypto platforms, what safer alternatives look like, and how to protect your assets in 2025. How to spot crypto companies that may be skipping KYC AML. Identifying a risky platform does not require a law degree. Most of the time, the warning signs are right on the homepage. You just have to know what to look for before you hit the deposit button. Website and onboarding signs that compliance is missing. The first sign of trouble is an onboarding process that is too easy. If a platform promises instant high-limit trading with no ID required, stay away. While privacy is important, any service that holds your funds is legally required to know who you are in almost every major country. Pay attention to the fine print. Look for a clear legal or terms of service page. If the site does not mention an AML policy or risk warnings, it is likely flying under the radar. Be wary of companies that market no KYC ever as a primary feature. This is not a badge of honor. It is a confession of non-compliance. Also check if they list a physical address or a registered legal entity. If the team is anonymous and the company location is a mystery, you have no legal recourse if they disappear. Business model clues, where the money comes from and who the partners are. Real crypto businesses need connections to the traditional financial world. They need banks to handle wires and payment processors to accept cards. If a company only accepts deposits in obscure tokens or uses offshore payment gateways that change frequently, that is a red flag. Check for a proof of reserves report. This is a public audit that proves the company actually holds the assets it claims to have. If a platform offers guaranteed high yields while ignoring ID checks, they might be using new investor deposits to pay old ones. These structures often collapse when regulators step in. If they cannot tell you who their market makers or banking partners are, they probably do not have any. Safer ways to invest in crypto while staying on the right side of compliance. Investing safely is about finding a balance between the freedom of crypto and the safety of the law. Compliance does not make a company completely safe from market swings, but it does protect you from platform risk. What to look for instead: basic compliance and transparency signals. Look for companies that are open about where they are based and which licenses they hold. A transparent business will list its compliance contacts and provide a clear fee structure. You should be able to find their name on official registries or through reputable news sources. Strong security practices usually go hand in hand with good compliance. Look for two-factor authentication, cold storage for user funds, and a history of regular security audits. If the company has a responsive support team that answers technical questions, it is a sign they have invested in a real business backend. Always verify this information on third-party sites. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.